Hi, everybody that's here. Oh my gosh, you are all so on time. We'll give people another couple of minutes to trickle in. Hi, everybody that's coming in. We're going to wait for some others to trickle in. So let's just give it another minute. I'm also checking my email because I know somebody's going to have a question about how to get logged in. Okay, I think that we're mostly good. Hi, everybody. I hope everybody is doing okay considering. It got really fucking weird out there, didn't it? So thank you all for joining me. I am just gonna really quickly go over some general housekeeping ground rules for the webinar as we allow the rest of the people to trickle in. And so let's just get started there. Just so you know, this is being recorded. Because it's being recorded, do know that if you ask me a question throughout the webinar, that it will be on the recording, and I may sell this recording later. So if you ask a question, you're giving me the authority to then sell that content later. So do be aware of that. In general, actually, I believe that it's best if you try to hold your questions until the end anyways. That way I can chop that part off. Also, I just try to move through information pretty fast. And the reason for that is I want to be respectful of everybody's time. I know that I said that this webinar was going to be an hour. I've been known to go over before, and hopefully you'll be patient with me and be understanding that if I do go over, it's just because I'm trying to provide as much useful context as possible. It's not just because I like to hear myself talk. That's only one of the reasons. And so do bear in mind that this might go over an hour. I do ask that you wait until Q&A for the end. I also do ask that if you do have a question, like if I explain something and it's like totally wretched, I do a terrible job, feel free to stop me and ask me to explain something again. The way that this is going to be structured, I will be going over similar concepts in multiple ways. So if it doesn't quite register the first time, there's a good chance we are going to revisit that same idea. But that said, if you do just think, you know what, Dumpster Dog, you did a real fucking bad job explaining that concept, then do feel free to interrupt me. I'm so happy to go over it again. Just do remember that you're all on mute right now. When you enter the chat room, you are all put on mute. And that's so that it keeps me at the center stage. Like the last thing we want is for you to, suffer the embarrassment of like farting and then Zoom pulling your picture up and putting you on blast like that. And so do know, somebody's already using the chat. Oh, thank you, Megan. Okay, so just so you all know, with the chat function, I love the chat function. Feel free to use it and speak amongst yourselves. I will not be checking the chat as I progress throughout this webinar, at least for like the first hour. And the reason for that is I'm going to be sharing my screen, and I actually have to click out to see the chat function. And so again, I welcome your questions. I want your questions. We will spend plenty of time getting to everybody's questions. But if you can hold off into the end, that would be great. And I do prefer questions to be shouted out since I won't be checking the chat bar. But thank you, Megan. I appreciate that you're here as well. What else do I have on housekeeping items? There will be an email copy of this sent out later. So if you need to drop off for whatever reason, or if you want to revisit some of these concepts, do know that this is going to be emailed to you. So no worries there. Other than that, just thank you all so much for being here. I really scrambled to put this together. And so I finished it quite literally 5 minutes ago. And so I appreciate you being my guinea pigs. I have a feeling that this is a webinar or a talk that I'll be giving more times than just this one time. So I really appreciate you all being my guinea pigs and being patient with me as I progress throughout the material, knowing that this is really a first time for me too. In fact, as to like what slide is coming next, your guess is as good as mine. And so we will be figuring it out together. These slides are going to be a little bit text heavy. That's not generally how I like to run my courses and my classes, but because I was putting this together so last minute, there wasn't really an option for me to add a bunch of memes and add a bunch of images like I typically like to do. And so I hope that at the end of the day, it's actually helpful to have the text so you can read along with it and go back and revisit if you need to. Other than that, I'm really not going to spend a lot of time because I know our time is limited on my intro. I think most of you, if you signed up for this webinar, most of you know who I am. If you don't, my name is Amanda. I also go by Dumpster Doggy. I used to work in investment management. I did that for quite a while. I worked directly with high net worth individuals, keeping them apprised of the portfolio strategy. And actually, this is really bringing me back to the old days, because in the aftermath of the last crash in 2008 and beyond, my job was essentially to make sure old rich guys didn't do stupid shit with their money. And so it's all like feeling very familiar to me. But I had quit that years ago to turn around and get this information to demographics that I care about, which happen to be young women or really anybody who has felt left out of these conversations, because so often these conversations are reserved for those who are already wealthy, which doesn't make any sense. And so that's a little bit about me. I'm going to go ahead and share my screen right now. This is never very smooth, but bear with me. And so hopefully everybody can see both me and my slides. And then we'll go ahead and get started today. I do have to start with a legal disclaimer. This presentation is for entertainment purposes only. If you want personalized investment advice, you must consult a certified financial professional. Do know that there is inherent risk involved in investing, and that is a risk that you are taking on if you decide to invest. Also, don't sue me if the stock market goes down, all right? Okay, I'm telling you right now, we all saw the stock market can go down. It could go down more, and I can't be responsible for that. I am not responsible for the stock market. So just do be aware that this is for entertainment purposes only. And so let's go ahead and get right in. For everybody that was trailing in as I was going through the ground rules, thank you. Welcome. Thank you for signing up and welcome. And I hope that everybody's hanging in there. I wish that we weren't hanging out under these circumstances, but yet here we are. And so it is definitely my goal today to help you breathe a sigh of relief about what it is that you need to do with your investments, but then also talk about what happens if we do encroach on more tumultuous economic times. And so So let's just get you a plan. I want you to walk away from the next hour feeling like you've got a grasp on not only what you need to do with your money today, but also what to do with your money long term. And so we'll be talking about both the stock market and volatility, and we'll be talking about the economy and a potential recession today. And so thank you so much. Again, you are going to get the recording. And so just sit back and have a drink and let's get to learning. And so I'm just going to go ahead and really dive right in with a couple pieces of terminology that I think people just maybe don't even like quite understand or haven't wrapped their head around. And that is the idea behind a bull market and a bear market. You've probably heard these words thrown around a lot, specifically a bear market in the last couple of weeks, because we have officially entered into bear market territory. Bear markets are negative movement in the stock market. Okay, I see somebody chatting in. Just as a reminder, I'm not going to be able to see the chat bar throughout this webinar, just so you know. So either shout your questions out or hold them until the end. And so a bear market, so a lot of us are in our first bear market. Again, this is considered to be negative price movement in the stock market. A bull market, on the other hand, is positive price movement in the stock market. And so the bull is what is often celebrated. For instance, this bull statue is what sits on Wall Street. Yes, I did have to have a very old Italian tourist hoist me up onto the bull to take this picture, if anybody was worried or curious. But again, the bull market is often celebrated because that's when things are growing. That's when we see positive price movement in the stock market. Now, I do want to tell you where bull and bear markets got their names, because I always love a little bit of historical context, if you could even consider it that. So actually, the bull and the bear markets were named for each animal's respective fighting style. So for example, the bull, when fighting, will drive its horns at you and up. So hence the up market. And a bear market is named such because a bear's fighting style is to paw down. And so hence the negative price movement. If you're thinking, wow, that's really fucking stupid, you're right. It's so dumb and arbitrary. Don't shoot the messenger. But I always think that this is helpful in understanding why things are named the way that they are named, even though if it doesn't make a ton of logical sense. By the way, don't go Google sad bear if you're trying to keep your positivity levels up. It's not a good time. But anyway, so bear market is generally negative. I like to remember, I like to think of it as like a bear market leaves you feeling bare. Okay, so it leaves you feeling a little bit naked, a little bit vulnerable, a little bit bare. That's how I remembered it when I first learned these things. Now, what you will notice is what I have not said is that a bull market is good and that a bear market is bad. Because that's how you would generally hear people describe bull and bear markets. But whether a bull market or a bear market is good or bad depends on the vantage point for which you are looking at stock market investing. And in fact, if you are an investor who has a long time to invest, a bear market is actually a good thing. And this is super counterintuitive. And what I want to do is stop myself really quickly to say that what I don't imply is that what is happening all around us is good. A stock market crash, like what we are seeing out there, is often coupled with an economic downturn. And that is not a good thing. Anybody that wishes for a bear market or that wishes for a recession, you don't really hear that, but you hear people wishing for a bear market, they're an asshole. Through and through. That said, if we approach this from a strictly, all else aside, which is very difficult to do, but if we are approaching this from a strictly investment standpoint, then a bear market is technically a good thing. The most counterintuitive thing about investing in the stock market is this, and this always throws people off. The point at which you have the highest potential for future returns is when we are presently in a bad market. The lowest potential for future returns is when we are presently in a good market. And this has to do with the cyclical nature of investing in markets. And just really simply, just even looking at this graph without even worrying about the years, if you look at a year like, let's say, like right about here, is this a good time to invest or a bad time to invest? Well, it's a good market, that's for sure. Everybody around you is super excited. Everybody is calling this a good market, a bull market. And so it may lead you to believe that it is a good time to invest. But in fact, the opposite is true. When we are presently in a good market, that actually gives us the lowest potential for returns in the future, because look at what happens thereafter. After a long run up, the market tends to come down, and vice versa. After the market comes down, then it tends to go back up, right? Wouldn't a much better time to invest be here, when we are presently in a bad market? Because when we are currently in a bad market, there is a higher potential for future returns. And so I just dove right into this concept. I am going to go ahead and like unpack and deconstruct everything that I just said throughout the next hour, but I just wanted to lead with this so that you can keep this in mind, keep this little nugget in mind as we progress through all of the information about how the stock market works. I also wanted to get it out of the way right up front, just because I'm worried, since this is my first time giving this specific webinar, I'm worried about bogging you all down in too much information. And so I just went ahead and made like the first 2 or 3 slides of this presentation, basically everything you need to know about investing. Here's your next one. If you don't pay attention to anything else for the rest of this webinar, allow it to be this page. Too long, didn't read, here's the summary. The summary is this. The first thing that we all need to do is check to make sure that we have enough cash to get by through whatever happens. And nobody really knows how long the current state of things is going to go on. And so use your own personal best judgment. I would say that for most people do not have enough cash currently, and so this should be their primary focus. Investing isn't your primary focus. Your primary focus is absolutely getting through the next 6 months, year, or 2 years. And so if this sounds like you, the good news is this is all you need to work on. You don't need to worry so much about the investing piece. All right, and then the next 3 bullets are about investing. And this is what we'll be covering through the last part of class, and that includes that the stock market cannot be timed. Historically, the best investing strategy is to just remain calm and keep adding money in methodically without paying attention to what is happening in the market. We don't want to let what is happening in the market right now dictate whether we should invest or not for the long term. And we'll come back to this. And then the last bullet is don't invest any money that you can't afford to lose. Pretty self-explanatory. If you're not willing to lose that money in the next year, 2 years, or indefinitely, then it's probably not money that you should be invested in the stock market. And so do bear that in mind as well. And so again, this is your summary for what we're going to be covering as we progress throughout the webinar. And so first, what we're going to actually do is take a step away from the investing piece. I came out of the gates hard with investing, but let's actually take a step back and talk about recession strategy. I know that when I first came out with this webinar, it was only going to be stock market volatility, because 2 weeks ago, we were really only talking about stock market volatility. And then so much changed, like every day, so much is changing. And so like over the course of a week, what I realized that there was going to be just as many, if not more people who are not just worried about their investments, but also worried about what they need to do to get through a potential economic downturn. And so first, what we're going to do is talk about that. We're going to talk about a recession strategy. Then we will be moving to the investing stuff in the last part of the webinar. It is notoriously difficult to give a talk on what to do with your money to a very diverse set of people, because everybody is starting from a very, very different spot. And so there are going to be some of you that really only need to hear this first part, the recession strategy part. There are going to be others of you that really only need to hear the back half of this webinar. And so like, if that's you, please feel free to drop off after the recession part, or if you like want to go have like a little break, make yourself a little bit of dinner and come back for the investing part, that's fine too. Just know that I'm trying to cover probably too much in the next hour plus. And so let's start with recession strategy. But before we get into recession strategy, let's just talk about, again, this terminology that we're using. Because a recession is a word that only applies to the economy. It does not apply to the stock market. The economy, when you think of the economy, you could basically think of it as everything, all economic activity. The economy is essentially the sum of all goods and services out there, which includes what we consume and what we produce. There are really three ways to measure GDP, to measure the economy. This formula is probably the most popular. So GDP equals consumption. So what are we consuming? Business investment, government spending, and then net exports, exports minus imports. And so that is what we call GDP, or gross domestic product. I don't think that this is super important. What's mostly important for you to understand about the economy is that the economy touches all of us. The economy affects all of us. The economy is without a doubt more important than the stock market, right? Because with the economy, we're talking about people's livelihoods and people's jobs, people's ability to put food on the table. And so this is absolutely, like, if we're talking about how do we fix this thing, fixing the economy on a grander scale should absolutely be our priority. When we have a recession essentially means 2 negative quarters of growth in a row. Growth and negative, I know that those two words don't seem like they go together, but you can just think of it as like essentially the economy contracting or shrinking as compared to the previous quarter. When that happens for 2 quarters in a row, you are technically in a recession. So what that means is that we aren't technically, according to the textbooks, in a recession yet, but like, let's be honest, we are in a recession. Businesses are shutting down. People are losing their jobs. Of course, we are in a recession, even if it does not meet the textbook definition, which is fine. And so what do we tend to see in recessions? We see businesses closing. We see job layoffs. We see businesses making major shifts. Often that shift is to playing defense instead of offense and just trying to stay afloat. And again, a recession will touch everybody, and it will especially have an impact on our most vulnerable. And so that's a recession. Let's compare that to the stock market. The stock market is really just that. It is just the marketplace for stocks. Stocks, which are these itty bitty little shares of ownership in companies, and not all companies, only publicly traded companies, which makes up a big piece of companies out there. But not every company allows their stock to be on sale and able to be purchased by us. Not all companies offer stock to the public. So like, for example, okay, this is a good one. You know how people are always like, oh, buy what you know. Like, if you're buying Lululemon pants because they make your ass look cute, well, then go buy some Lululemon stock, which is like, not great advice, but that's for another webinar, another day. But for example, if I applied this advice to myself, I would go out and buy Birkenstock's stock, because Birkenstocks is a company that I'm very passionate about. But Birkenstocks is a company that is not publicly traded. You cannot buy on the public exchange shares of ownership in Birkenstock. And so really the stock market, we're only referring to shares of ownership in company that are publicly traded on this crazy stock exchange, which is essentially just a marketplace. So it is a place that is a marketplace where we can go and buy, sell, and trade shares of these companies. Now, in general, the stock market is growing in size. That's what we call a bull market. But it is possible for the average of all of these shares that are for sale out there in the market, it is possible for them to contract as well, for them to temporarily lose value. And that's what we call a bear market. And so a bear market is essentially just a decline in the overall value of the stock market of over 20%. So for example, if you had like a $100 investment in the stock market and it fell to $80, so you just lost 20%, right? Well, I'll get to that. I was going to say it's not a loss until you sell the thing, but I'll come back to that. But a dip in over 20% is what makes a bear market. And so who does a bear market affect? Well, it's mostly going to affect the people that have stock investments. And that's not to say that there are not absolutely ripple effects that happen when we see bear markets, but for the most part, a bear market is going to affect the investors of those companies, the investors who hold those shares, the investors who are invested in the broader stock market at large. And so for most people, diverting attention away from your investments and toward your money plan for the next year is a good use of your energy. In my opinion, getting through a recession is really difficult, but dealing with a bear market or stock market volatility can be pretty easy, because as you will find, really the advice with a bear market is to do exactly what it is that you're doing currently, or to do nothing at all. Don't change your strategy now. And we will come back to that. We will explain why. But that's what I want you to like at least have a sigh of relief and feel a little bit better knowing that with your investments, there's really nothing for you to do right now. And instead, what we can be doing is focusing on making sure that we're taking care of ourselves and our ability to get through the next year or 2 years, knowing that it's really hard to see what's going to happen. It's hard to know what's going to happen. And really that's going to be our highest priority. Now, throughout this webinar, I'm going to be sprinkling in some frequently asked questions. And so one that I get all of the time is, well, okay, should I be buying into the market right now? And it's a really great question. But the very first part one to this answer is, well, do you have enough cash to get you through the foreseeable future? Because that is going to be your most important priority. Yes, there are deals out there right now. And if the bear market continues, there will be even better deals. But right now, your priority is to get through the next year, and therefore your priority is to make sure that you have enough cash available to do so in the event that your job goes away, right? I love this tweet by my friend Tanya. It's, how much cash do you have saved right now? Enough, if you couldn't work for a month, 6 months, a year more. Yes, the market dip, correction, maybe start of a recession will create stock buying opportunities. But right now, mind your cash savings first and wash your damn hands. And so let's go through, if you're somebody that is in a position where you are maybe staring down the barrel of a layoff or having your work slow, let's just talk about really briefly some things that you can do. Just so you're aware, this is not really what I'm going to be focusing the majority of this webinar on, but that doesn't mean that it's not important. And I will be providing you with resources of other people who are educators like me, who are doing really good work in helping people recession-proof their lives. But just in general, what do you want to be doing is just try to free up as much cash as possible, which means cutting non-essential spending, which obviously nobody wants to hear, but like, I don't know, if I was anybody really, I would be putting a real cork in any spending that is not totally necessary until we have a little bit more clarity about how this whole thing is going to pan out. Keep that cash somewhere where you can access it. That's the most important part. Yes, high yield savings accounts are great, but you're not getting paid shit in high yield savings accounts right now. And so like, yes, it's important to have savings accounts, but like, just like keep your savings. Like for now, what's most important is that you keep your savings somewhere that is FDIC insured and that you can easily access it, okay? If you're afraid that you're going to miss bill payments, then get out in front of it, proactively call your providers and ask what they can do to help. everybody knows what's going on right now, and so do not be afraid to ask for help. Also, if you do believe that you're going to end up in a situation where you're going to need to use credit to get through a difficult time, obviously it's not ideal, but also no judgment. This is just the way things are in this country. Then do prioritize which bills that you absolutely need to pay for in cash and which ones you could ultimately pay on a credit card. Try to negotiate all of your bills. Try to see if you can get 20% off on your bills or get a grace period, and do it now before things get worse. And so get out in front of bill payments. Get that income tax refund if you're expecting an income tax refund, get that cash in your pocket. And then also not ideal, but if you feel like you're going to end up in some sort of cash crunch, you may want to consider suspending your retirement contributions. Now, this may sound counter to what we're going to be talking about during the investing piece, because during the investing piece, the recommendation would be like, yeah, let's keep those retirement contributions getting into the market, buying into the market during this bear market. But if you are going to be tight on cash, then the investing is not your concern. And so maybe what you'll want to do is consider rerouting any of that money that's currently going to your retirement plan and get it into your pocket. Don't spend it, but save it for getting through this difficult time. So for debt repayment, similar to your bills, call your banks, call your loan providers, see what they can do to help you out. Talk to your lenders about hardship accommodations. See if they can pause your payments. Consider only making the minimum payments on your credit card right now, and using any money that, if you were like doing accelerated payments on your credit cards, consider beefing up your emergency fund instead. Again, this is not the typical advice that you would hear during non-recessionary times. But right now, what we need to do is make sure that you have as much cash available as possible to get you through the next however long. And so maybe what you'll want to do is start, and this is only if you're in a situation where you're worried about making it through a recession, which could last 6 months or a year. You maybe consider only making those minimum payments for now so that you free up some cash. Also, try to negotiate interest rates and other leeway on credit cards. Interest rates are something that they can lower if they want. And so call them up, have calm, collected, cool conversations with these people and ask them what they can do to help you. Don't be afraid to do this. Also, consider looking in, if you are going to use debt to get through a tough time, you may want to consider options that are available to you that aren't a credit card, just because credit cards have an exorbitant, super high rate of interest, right? If you have bad credit and you apply for a credit card, then you may be looking at a 20, 25, 27% rate of interest that you're paying on that credit card, which is really painful. And it's really hard to come back from that. And so do explore all of your options for debt in the event that you do need to use debt to get through a really tough time. Again, what I'm trying to do is just be really realistic about the fact that a lot of people are not going to be able to make it through the next 6 months to a year without utilizing debt. And so just do know that there are ways to be smarter about it than others. And so be cognizant of that. And also no shame, do what you have and just, try to be as smart as you can about it. All right, let's talk a little bit about jobs and layoffs. This is a tough one. I really encourage you to have calm and thorough conversations with your workplace about what you can expect moving forward. Hopefully your workplace is being as transparent with you as possible about what it is that they're thinking as far as layoffs. That said, I would absolutely prepare for the worst. The future of your job is absolutely a business decision, right? Your company could love you very, very much. And at the end of the day, unfortunately, it does not matter. If the business cannot afford to pay you, then they cannot afford to pay you and they may lay you off. We may end up seeing some legislative help on this front, but I would expect that the most likely scenario would not be that your business gets some sort of governmental help and is therefore able to keep you on. It is much more likely that we will see a bolstering of unemployment benefits. And so what your job probably should do is is then lay you off so that you can then go and collect unemployment from the state. And so if you're laid off, don't forget to do it right away. I know that some states are like waiting, like the mandatory waiting, waiving the mandatory waiting period before you can file for unemployment. So get in there and file for unemployment and see what you can get. And also watch out for other forms of legislative relief on both the state and federal level as we progress throughout this thing. Another strategy that you might want to consider taking is trying to diversify your income sources before a job layoff happens, if possible. I kind of hate this advice on one hand, because I think that we're all already overworked and anxious and stressed, and trying to figure out another way to make money is really not ideal in this scenario. But if you are worried about a job layoff, it might be smart to get started thinking about this now. Do know that there are going to be businesses and industries that are hiring, grocery and food delivery, manufacturing, healthcare, childcare, coding, software engineering, IT, and so on. And so it might, if you need to find a new job, it might require you getting a little bit creative and looking around and seeing what people need right now. But as far as I can tell so far, is we are not seeing like a normal recession kind of sees like a shutdown across the board. But this situation is so unique that we're not seeing that quite yet. You know, for example, I saw 2 requests for video editors today online, and that makes perfect sense, right? Like if we are all moving to online content, education, and so on, then of course video editors are going to be needed. I saw that Costco is hiring like thousands of people right now. And so do be creative about what people need right now. The way that these things typically tend to work is that changes in economies and cultures of this scale will always eliminate some opportunities, but they will also create other opportunities. And so as far as creating multiple streams of income, there's some different things that you can consider doing. I'm not going to get into this all that much. This is not necessarily my area of expertise. There are definitely a lot of financial educators that love to focus on this, but just know that you have a skill that someone somewhere in the world absolutely needs. Absolutely needs. Get creative about it, right? Look into virtual assistant work called VA work, offer your skill online, think about creating a product to sell online. You know, one really easy thing that you can do is talk to your friends who are business owners. What do they need help with, right? I mean, if you think about like the world, the population in general is shifting to this much more self-employed model. And so for example, I am technically a business owner, but I mean, like my area of expertise is investing. My area of expertise is not marketing. Like, have you ever seen my marketing strategy? Like, clearly I need some help, like open to taking pitches, right? There are so many of us out here who are self-employed, small business owners, and we need help, like whether it's marketing or accounting or, you know, help with admin. And there's so many things that folks out there are going to continue to need help with, probably now more than ever during this really complicated time. And so again, get creative. And so I've listed some resources here for you to check out. I'll email those out to you with the video as well. And I did want to just end the piece on recession preparation with just a few reasons to be hopeful. The first of those is we do have the internet and we have the ability to conduct work online. This was not the case in 2008, right? Granted, people were not confined to their homes, but like we are so lucky that we do have the internet and the ability to make money online. And in fact, one of my good friends, Kathleen, she said something along these lines. She said, we are at the very beginning stages of making money online. Right? We are at the very beginning stages of making money online. And so there's absolutely opportunity out there for you. Another reason to be hopeful is that we may not see a global recession with this coronavirus thing. There may be some pockets of normalcy and opportunity that can be tapped into outside of the United States. We are an increasingly global world, and so think globally. You know, if things get really hard in the United States, where it looks like that's where it's headed, just know that not everywhere is the United States, and there's opportunity outside of the United States. Also, there are online communities that are mobilizing and sharing resources. As hard as this time can be, there are also some really beautiful moments about right now. Find places online where you feel like you belong, and don't be afraid to ask for help. Don't be afraid to ask for help from your neighbors, your business friends, strangers on the internet. There's really a lot of love going around out there. And if you find the right person, somebody will take you under their wing. And so do know that that's out there as well. I almost didn't include this last bullet here because I don't want to be like a totally cheesy asshole about this, or downplay the fact that a lot of people are not going to come out of this unscathed. And so do know that I'm nothing but sympathetic and horrified for what we could potentially see moving forward. But for a lot of us, this is an opportunity for us to go in really deep and serve our communities. And I know from my own personal experience that in focusing on serving your community, there is opportunity for you as an individual. And so it's just something to keep in mind as we progress through a really, really difficult time. And so I hope that that's at least a little bit hopeful for you. Now, on the flip side, if you are in a comfortable position currently, do what you can to help and to hire. And also, please, everybody, vote. I'm not going to get into politics on this call. I do happen to believe that there is one candidate out there who has the best grasp at what needs to happen on an economic level in order to rebuild small business and the middle class. If you would like my opinion, you are certainly welcome to ask me outside of the webinar. And so please find me, but everybody, please get out and vote. How the rebuilding effort goes after this thing is all said and done will have a lot to do with the type of government that we have in place. Really, at the end of the day, a lot of this financial literacy stuff, yes, it's helpful to know tips and tricks, but the reality is we need real change on a systemic level. And what I never want anybody to think is that I believe otherwise, right? We need really massive systemic change, and we're only going to get that on the political front. And so that's my 2 cents on that matter. And so next we're going to move into the investing piece of the webinar. This is going to be the bigger piece of the webinar. And so just do know that this is what we're going to be covering from here on out. And so first what we're going to do is a little bit of an investing 101 refresher, because what I'm hearing is things like, I'm freaking out about my 401k. What am I supposed to be doing? And I didn't even know that I was invested in the market in my 401k. And now I'm looking at it and it's lost a shit ton of value. What the hell is going on? And so in order to understand why the stock market operates the way that it does, and why you are invested in stocks right now in the first place, especially if you had no idea that you were, is actually doing just like a little bit of a backtrack and doing a quick investing 101 refresh. I do not have time to cover everything. And so if you would like to do a full investment course, I have a full investment course. And so unfortunately, I will not get to cover every single topic in this webinar. But let's go through just a couple of items that I think are going to be really helpful in setting the foundation of understanding for you so that we can then tackle stock market volatility. And so first, when we are investing for the long term, and oftentimes long-term investing happens within a retirement specific account. So like for instance, a 401k is a retirement account. a Roth IRA is a retirement account. A traditional IRA is a retirement account. But the 401k, the Roth IRA, the IRA, those things that I just listed, they are just accounts. They're like kind of fancy special tax advantaged accounts, but at the end of the day, they're still accounts. When we are seeing this crazy up and down volatility, it has to do with the investments that we are holding within those accounts. Because a 401k can hold all sorts of investments. It can also hold cash. The 401k is essentially just the garage where you park your car. The car is going to be your investments, which with most 401k plans or 403b plans or 457 plans, or if you were to open up your own retirement account and invest, the investments that we are speaking of are these two investments, stocks and bonds. Stocks and bonds really exist as like the building blocks for building out an investment strategy for the long term. Now, there are other asset classes that you could look to integrate into your strategy, but we're doing Investing 101 right now, and what you need to understand is the trade-off between stocks and bonds. Not only will the majority of you be investing in these two asset classes, but also I truly believe that once you understand the risk and reward trade-off between stocks and bonds, you can then take that knowledge and apply it to other investments that you may consider building into your long-term strategy. And so let's talk about stocks and bonds, because really it's just these two items or these two asset classes. Now, at this point, I always get somebody saying, okay, but like not me, I am invested in mutual funds. Well, a mutual fund is essentially just a big old basket that holds some other investment type. And so, for example, if you have an equity mutual fund, well, what's that? That is a mutual fund that holds stocks, equities or stocks. And so, for example, your fund could be a big old basket of stocks, and it holds Google stock, Apple stock, Microsoft stock, all sorts of stocks. The mutual fund is essentially just bringing them together in one basket so you can easily click and buy all of those investments with just one keystroke, just one click of a button, right? And so there are a lot of ways that you can own stocks. Mutual funds and exchange traded funds is one of them. But if you own a mutual fund and that mutual fund holds stocks, then you are very much invested in the stock market. And this is where I start to see a lot of the confusion, is people not realizing that the way that 401ks typically work. And so I often use 401k as a catch-all, like we're talking about retirement accounts and plans in general, is often the way that they work, especially when they are set up through your workplace, is the 401k is the account, and then you are automatically invested using funds, but the underlying investment, the real thing that you're investing in, is the stock market or in the bond market. The mutual funds are just allowing you to invest in different markets. And so there's really a lot of different ways that you can own stocks and bonds, but we're going to focus on stocks today. And the first of those is owning individual stocks, right? You can go out and buy Tesla, buy Weight Watchers, buy SeaWorld, buy whatever stocks that you want to own. You can also own stocks in mutual funds, just like I explained. Same idea with exchange traded funds. It's still a fund. A fund is a fund is a fund. It's a big old basket of some other investment type. And then there are also these things called target date or life cycle funds. If you have a retirement plan through your work, you may have noticed that there's an option that has like a super far off date in the future. Like it might say retirement target date 2065. This is actually a fund that holds other mutual funds. We're not going to get into the nitty gritty of how they work, except for to say that these funds are also invested in a majority in the stock market. So if you own a retirement target date life cycle 2065 fund, that fund is probably invested about 90% in the stock market, 10% in the bond market. And so no matter which one of these methodologies you're currently using, you are absolutely invested in the stock market. And so I always love to drive this point home because I think people get really caught up in like the fact that they're using mutual funds, which mutual funds you can think of as just essentially the suitcase that holds all of the investments, right? So your suitcase just holds all of your investments for ease. It will help you get from point A to point B with relative ease. Now, what is going to really flavor the type of trip that you are about to have is what is actually being held inside the suitcase. And so like, let me give you an example. So like, let's say there's two different travelers. They're about to have two very different trips. So traveler one, let's take a peek at what's packed inside their suitcase. Well, it's whips and chains, a creepy eyes wide shut mask, and oh look, a wizard's cape. That's what traveler one is packing in their suitcase. Now let's compare that to traveler two. Traveler two in their suitcase is packing earplugs, a cable knit sweater, and a nice long read that they picked up at the airport. So clearly, these two people are about to have very different trips. These people are about to have very different journeys. And it's the same idea with a mutual fund. If you have a mutual fund that holds stocks, you are about to have a very different journey than a mutual fund that holds bonds. And so I just like to clear this up front because again, I so often hear people say something like, I'll be like, oh, like what are you invested in? And they're like, oh, mutual funds. And I'm like, you're right, but what are those mutual funds invested in? What are those mutual funds invested in? Because that's really going to tell you what you can expect out of this investment in the future. The mutual fund itself is just the packaging. It's just the suitcase that holds all of your investments together. And so let me give you an example so you can visualize this. Here is a Vanguard Total World Stock Indexed Fund. And so this is a fund, a mutual fund that you can buy at Vanguard, and it covers stocks, and I shouldn't say cover, it holds stocks all across the globe. And so just with buying this one fund, you are now investing in these 8,000 stocks. So yes, you are buying, let's say VTWSX, that's its ticker. You are buying this fund, but what you are really buying is the investments that are being held inside the fund. And so this is why so many people are confused right now, being like, I literally had no idea I was invested in the stock market because I was invested in mutual funds, or I just thought, you know, my 401k was enacting some sort of strategy. I didn't realize that what was underlying was actually stocks. And so for most of our retirement plans, they have at least a majority, if not a very large majority, invested in the stock market. And so really quickly, let's do a quick review of just what is a stock. So again, a stock is going to be a teeny tiny little sliver of company ownership. It's like a certain percentage of ownership in a company. And that's why stocks are also called equities, because you now own equity in a company. The idea behind a stock, owning a stock, is that as the entire pie grows, as the big pie grows, your teeny tiny little piece of the pie also grows as well. That's the idea, right? That's the investment. You are quite literally investing in a business. You can invest in a business like Target, or again, like Lululemon, or like Snapchat that brought us this beautiful filter. You can literally invest in that company. And do you want to? I don't know. That's up to you. You can invest in the company that makes Roombas. You can invest in the company that is going to profit every single October when they put out pumpkin spice lattes, right? The idea is that as the company makes more money, you will too. Now that's an oversimplified example of what happens. Well, and we'll get back to that, but that's just the very general idea with owning a stock, is you are now invested in how well this company does in the future, right? And you would only ever buy a stock if you thought that company could make you money in the future, or you would only invest in stocks in general if you thought that the stock market was going to grow in value or in size in the future. That's the point of investing in stocks. You're investing in businesses. Now, stock returns do come in two forms. So first, When that little bitty piece of your pie, when it's growing in size, so the price is growing. That's what we call price appreciation. That's, I think, what we typically tend to think of when we think of stocks. Like, even when people are like, buy stocks on sale, it's because, like, right now it costs a lot less to buy the same amount of shares, right? It's temporarily decreased in value. And we also think about it on the flip side, right? When you think of like, damn, I really wish I had bought into Apple or Amazon 20 years ago, right? Like, what you're thinking is like the massive price appreciation that has happened for any one share of stock over time because the company has grown so wildly. But that's only one piece of it. And equally as important and often overlooked piece is the dividend payout. So a dividend is really nothing more than a payment from that company to all of the shareholders, like, hey, thanks for being an owner. Here's a little bit of cash to keep you happy, investor. And that's what a dividend payout is. This is just a cash payment to all of the shareholders. So, like, to give you an example, maybe a company that has a stock that is trading at $10 per share is going to pay out a dividend of 50 cents per share. And so that's going to be then a 5% dividend yield, which is really great. And so between your little piece of the pie growing over time and these, like, hey, thanks for being a homie cash payments, you get a total return in the stock market. Now, the stock market historically has averaged about 10% over time. 10% a year is an average over time. Moving forward, we could probably expect it to be lower, to be honest. We should probably downgrade our expectations. And there are multiple reasons for this, which I don't have time to get into on this call. But I just think in general, when we're making projections looking forward, it's always good to be more conservative with your estimations of what we can expect to receive anyway. And so, like, let's just take it down a notch and downgrade our expectations. Maybe we see like a 6% annualized return moving forward, 6% being the average over long periods of time. Stocks do tend to be considered risky due to what we are experiencing right now. And what we are experiencing right now is called volatility, short-term volatility. Prices taking a big old plunge, right? Stocks basically hiding underneath the covers, like only eating leftover Thai food, like, doing one of these, like, that's what's happening right now. And this is the risk that we take when we invest in the stock market in the short term. Really quickly, I mentioned this earlier, but do bear in mind that stocks trade on an exchange, like, for example, the New York Stock Exchange, which, again, just think of an exchange like a big giant marketplace. It's a marketplace where you can go to buy and sell stocks. Don't sell anything else, they just sell stocks, but it's still very much a marketplace. So that means that every buyer must have a seller and vice versa. Now, you don't ever see that happen because you're just putting orders in online. But basically, behind the scenes, what is happening, the way that all the banks are hooked up, is that they are literally finding a buyer to your seller or a seller to your buyer. And so it is very much a marketplace. But there's something kind of funky about this marketplace, which makes it so completely unique. And that is the very fact that we get minute-by-minute updates about the price of each thing that is for sale in this marketplace. This is so unique. Just think about how weird this is, right? Like, we don't get an update every 15 seconds about what the value of our homes are, or what the value of our personal businesses are, or our Beanie Baby collections, or our Cabo timeshares, or whatever it may be, right? Whatever investment it is that you have, there's not a ticker on it telling you every single second, whispering into your ear what the value is. But we do have such a thing with the stock market. And so what we're essentially getting is minute-by-minute price updates on what stocks are worth. And I think that it's, in general, a pretty unhealthy thing, because we don't need frequent price updates on the value of our stocks. When we own a stock, when we buy a stock, we are essentially buying into a company. We now own a certain percentage of that company. And whether the stock market values it at $10 today or $9 tomorrow or $11 the next day, it doesn't matter because you still own the same amount of the company, right? You don't own 1%, but it's easy to conceptualize it that way. Like imagine when you're buying a share, you buy 1% of a company. It's really like 0.0000001%, but imagine it like it's 1% of a company. Just because the market is temporarily pricing that at $80 versus $100 doesn't really mean anything because you still own 1% of that company. We don't really need frequent price updates on the value of our stocks, but yet here we are. We have them. And so we have to deal with it and more or less learn to tune out the noise and just constantly remind ourselves what it is that we own when we own a stock. We own a stake in a business. We own a stake in a business. We own a stake in a business. So tell yourself that over and over and over again. Now, really quickly, let's compare stocks to bonds just so you have a comparison point. If you've taken one of my courses before, I'm sorry that this is a little bit of a review, but I think it's always good to review just to really hammer these ideas into the old skull. And so what is a bond? A bond is essentially a contract between you and the government, either the federal government or a local government, or you and a company like, say, Coca-Cola, where you are quite literally loaning them your money. You are the lender now. You are the bank. Coca-Cola wants your money. Coca-Cola is saying, hey, mind if I borrow a little bit of cash? I swear I'll pay it back, and I will pay it back with interest. And, you know, unlike your drug dealing brother, Coca-Cola probably will. They actually will pay back with some interest on top. And this is the idea with a bond. It's just as straightforward as that. The money you earn on a bond as an investment is the rate of interest that everybody agreed upon when they entered into this contract. And so you could probably guess how much you can earn on a bond really has a lot to do with whatever prevailing interest rates are in the economy. Interest rates right now are pretty much zero. They are extremely low, especially by historical comparison, which means that it's a really tough time to be an investor in a bond right now. Another name for bonds is investing in debt, because you are investing in the debt of a company or in the debt of a government. And so right now, it's a tough time to be the bank, to be the lender, because you can't make a lot in interest. It's a much better time to be on the flip side of that equation and to be a borrower. For example, right now, you could get an extremely low mortgage rate. Now, that said, I'm not encouraging anybody to take out more debt than they need. That's absolutely not the point. But just to get you to see how this works in both ways when interest rates are high and low. Right now, it's just a tough time to be invested in debt, to be the lender, okay? And so historically, bonds have returned about 5% annually, but moving forward, we should absolutely downgrade our expectation. We will likely not see interest rates move as high as we have seen historically. And so, you know, maybe we see 2-3% returns in bonds moving forward. But the thing about bonds is because everybody knows what we're going to get out of bonds, which is not the case with stocks, right? With stocks, we have no idea whether these companies are going to grow or whether they're going to fail. But with a bond, everybody knows what they're agreeing on. And so while yes, there is going to be a little bit of trading and therefore some short-term volatility with bonds, it's not going to be nearly to the effect that we see in the stock market. And so in general, bonds are considered a little bit safer. Another word for bonds, by the way, if you're looking at your like 401k breakdown, is fixed income. Fixed income and equities is often the two words for stocks and bonds that they like to use on 401k breakdowns. The reason it's called fixed income is because you are getting paid a fixed rate of income when you own a bond. They're going to pay you twice a year, and they're going to pay you that stated rate of interest that everybody agreed upon. It is fixed rate of income. And so do know that that's another name for bonds. And so after hearing this, I often get people that say something to the effect of like, okay, like, why would anybody really ever invest in bonds. Like that's sounds like a pretty shitty deal, to be honest. Like, give me a little bit more juice, give me a little bit more heat, like give me those stocks. Well, as we are all experiencing right now, investing in the stock market can be very difficult because of volatility. And so volatility is often represented by a graph like you are looking at right now. But the problem with a graph like this, it does nothing to explain the real pain that one experiences on one of these downturns. Like, I could tell you all fucking day that this is totally normal, but it will not matter when you open up your 401k and you see a significant drop in value. And that's totally normal and natural. That means your brain is actually working in the correct way as far as like staying alive for many millions of years, well, thousands, I guess, of years out there in the wild. And we'll come back to our brain's response to this type of terror. But we do have to learn to train our brains a little bit differently. And so first, just understand that this is like, could be a graph of one stock's growth over time. So imagine like this is Nike stock. So this is Nike stock growing over time. Some years are good years, some years are bad years, which we often accept with the economy. Like, we know that Nike's not going to, as a company, have a good year every year. So then we also need to accept it with the stock market. Right? And so not every year for Nike stock is going to be a good year. That's just not the way that it works. Growth typically does happen, but it does not happen in a straight line up. It never will. And so this could be a graph for one stock's growth all over time. It could also be a graph of the total stock market growth over time. And so you always hear this 10% number thrown around. Like 10% is the annualized rate of return over long periods of time. And yes, this has historically been the average, but what I need you to understand is that it does not come in a pretty little package of 10% each year delivered on your doorstep, and that's that. That's not the way that stock market investing works. It is very, very much an average. You're going to have some years where the stock market is up much more than that. So you'll have really great years during bull market cycles that are up like 20%. You'll have other years that are much more tepid, like maybe stocks in general are up 2%. Or maybe you'll have a negative year where stocks are down 20 or 30 or 40 or 50%. All of these things, all of these possibilities have absolutely happened before, and they will happen again. But over time, what we've seen historically is that it averages out to about 10% a year. And again, I like to draw the parallel to like just human life in general, right? Like, of course, growth is never going to be linear. We know that that's not the case. Every person, individual, is going to have bad years. Every business is going to have bad years. Every economy is going to have bad years. Every stock market is going to have bad years, right? I often like to compare this to my dating life. I know at least some of you have heard me make this comparison before, but we're going to do it again because I think it helps make it stick. So some years, I hook up with like 20 dudes. Some years I hook up with like 2 dudes. Some years I hook up with like negative dudes, but over time it averages out to about 10 dudes per year, right? So 10 is very much an average, but it's not 10 every year. Obviously, it is not looking good in 2020, my friends. It is not looking good. I guess at least I have an excuse this year. But again, we're going to see growth, but it's not going to happen in a straight line up. This is what we mean when we say the V word, when we say volatility. And so if you take anything away from this class, please allow it to be this, and that is that bonds and stocks, or that risk and reward, let me say this again. If you take anything away from this class, it is this. Stocks and bonds, risk and reward are 2 sides of the same coin. I'm going to say that again. Risk and reward are 2 sides of the same coin. You do not get to have one without the other. If somebody promises you some sort of investment that is all reward and no risk, then what is it? It's a scam. It's a scam. Okay? You do not get to have one without the other. And this is embodied perfectly by the bonds versus stocks arrangement. I like to, again, compare this to my personal dating life. Again, I date men, so I'm going to use men as the example. So excuse my heteronormative trope, but it really does work here, so bear with me. So let's compare dating two different guys. So first is guy number one. His name is Steve. He is a very nice guy. He is an accountant. He tucks his t-shirt into his jeans and he thinks that Nickelback is hard rock. Now, you're not going to exactly be leaving any footprints on the wall at night, but he will be there to watch some Netflix programming with you on a Sunday. But you will not be sailing around the Mediterranean and taking ecstasy in Ibiza on your anniversary. Okay, so this is guy number one. Then compare that to guy number two. Now, guy number two, his name actually happens to be Guy. Now, Guy is the lead singer of an up-and-coming band. Now, this band could turn out to be the next Smash Mouth, but it could also turn out to be the next Rolling Stones. Dating him is a roller coaster. You might have to hawk some t-shirts out of the side of an airbrush tour van, but you could also be riding an albino tiger around his Miami Beach courtyard while you light your Newport Slims with $100 bills. Right? So with bonds, you pretty much know what you're going to get, but there is limited upside. With stocks, you really don't know what you're going to get. It is very unpredictable, but there is significantly more upside. And this is the trade-off of risk and reward that we see with investing. That's why I also like to compare diversification, which diversification is the idea of don't put all your eggs in one investment basket, which we need to come up with something better than that. I'll set a Starbucks gift card that comes up for somebody that comes up with something better than don't put all your eggs in one basket. But the idea is diversification in investing is very similar to playing the field in dating, right? The great thing about investing is I don't have to choose just one of these. I don't have to get married to one of these motherfuckers, right? The whole point is I can do a little bit of both. And sometimes this one is good and sometimes this one is good. And that's the whole point of having both. There are going to be market scenarios where one is better than the other. And so you build a strategy where you do a little bit of both, okay? And so again, that's this idea behind risk and reward trade-off. And I want to tie this all together with an explanation of why you may have stocks, stock mutual funds, or a stock-heavy strategy within your 401k without you even having realized it, because a lot of times stocks are considered the default investment for young people. And young people are people in their teens, 20s, 30s, 40s. I mean, even in your 50s and 60s and 70s, you're probably going to have at least some amount of stocks in your portfolio. But so in assessing what is the right balance between stocks and bonds for you and what makes the most sense for you, we call this, by the way, your asset allocation decision, which it's just this big picture decision of should I be in stocks or should I be in bonds? Or should I be in cash? Right? That's an option as well, doing nothing at all. Right? What is my big picture asset allocation? How am I going to allocate to my assets? Which actually is going to drive, this decision is going to drive the majority of your returns over time. Right? We get so caught up in believing that when we talk about investing, what we're talking about is Microsoft stock versus Apple stock, but that's not really the big decision you have to make. The big decision that you have to make is, am I invested in stocks at all? Or am I in cash? Or am I in some combination of cash, stocks, and bonds, right? And finding your perfect mix is going to be really important in being able to navigate times like this. I wish I could have told you this 2 months ago, but it's okay. Here we are. We all still have plenty of time to build out an asset allocation, a stocks versus bonds versus cash breakdown that makes sense for our goals. And really, when we're assessing our goals and our risk tolerance, we want to do so using time frame. And so let me explain what I mean by that. So let's say you've got a bucket of money. I want you to look at your bucket of money and I want you to ask your bucket of money, what's my goal for you? And when do I need you? What's my goal? When do I need you? And then also, what kind of risk am I comfortable taking with you, right? Because I often get this where I'll get somebody that'll ask me hey, I just got $1,000 tax refund. How should I invest it? And it's like, well, what do you want to accomplish with it? I can't tell you how to invest until you tell me what it is that you want to accomplish. Because the reality is there are only so many investment types out there. It's pretty limited. And so what you need to do is first decide what it is that you want to accomplish, and then puzzle piece that information together with whatever combination of asset classes makes the most sense for you once you understand what you can get out of these asset classes and what the risk of these asset classes is. That's a lot. That was a mouthful. So let's go through an example really quick. So goals and risk must be assessed using time frame. Let's think about like a short-term goal. So for example, I am saving up to buy a rental property, for a down payment for a rental property. That's a short-term goal. So I look at my pool of money and I say like, okay, what do I want to do with you? Like I want to use you. I want to deploy you in 2 years, right? When do I need it? 2 years. So then what kind of risk am I willing to take with this money? Honestly, pretty much none at all. I do not want to subject this money to the market, even if I think that the market is going to do well moving forward, because I know that it could always not do well, right? And so I'm going to keep this money in cash in a high yield savings account, call it a day. So that's a short-term goal. Now let's think about a long-term goal, which I think can be kind of counterintuitive. So what would be a great well, I mean, the long-term goal that we all think of is, of course, retirement, but it could also be like building intergenerational wealth or reaching financial freedom, whatever you want to call retirement. That's just another word for retirement. But that's a story for another day. And so you look at your long-term pool of money and you ask your pool, okay, what's my goal for you? Well, my goal is to not run out of money in retirement. That's the goal, right? When do I need it? Well, like for me, let's say 30, 35, 40 years from now. What's the biggest risk I take? And this is where it starts to get a little bit counterintuitive. What's the biggest risk I take with this money? The biggest risk I take is not having enough, money. So therefore, the risk I take with my long-term money now is being too conservative too soon. Because historically, the stock market has worked. It has provided significantly more growth than other asset classes. But you need one thing to make it work. You need time. And younger people have the time to make it work. So we can come full circle to understanding why most people, young people specifically, have retirement strategies that are built out a majority into the stock market with a smaller piece in bonds. But then as you get closer to retirement, that switches. And you get more conservative in your allocation and you shift to more bonds, right? There's a really great John Oliver on retirement plans, which you should all definitely watch, where he breaks this all down. And what he basically says is that like, you should switch into more bonds every time a new James Bond actor is named. And so like, obviously that's facetious, but it's like, it's a good idea, right? Like the idea is slowly over time moving into more bonds. And so people then always want to know, well, like, okay, well then, so lady, tell me exactly how much I need. And I can't do that, because exactly how much exposure you have to the stock market has to do with really one thing and one thing only, and that is how comfortable are you with the stock market? How comfortable are you with what's going on right now, right? Because in general, yes, young people should have a majority of their portfolios invested in the stock market, but whether that's 90% of your portfolio or 50% of your portfolio is going to be determined by how comfortable you are. Because the worst thing you could do is have too much and then do something where you really end up hurting yourself during a stock market crash, which we'll come back to that, but spoiler alert, selling out at a low. You could really hurt yourself, which is sometimes the inclination during these stock market crashes because it's really scary. Now, there is a general rule of thumb that's used in investing and in personal finance, and it is take 110 minus your age. That's how much you should have in stocks. So for example, 110, if you're 30 minus 30, that's 80. You have 80% in stocks, 20% of your portfolio allocated to bonds. But that is just a rule of thumb. You could be more, you could be less. It all depends on your comfort level. And so that's your Investing 101 refresh. Now let's actually start to dive into understanding stock market volatility and understanding stock market trends. Another way to say this is like, okay, so that's great. Now we know this, but like, how does it all actually shake out? what do the numbers look like in the stock market? And I think that it really helps to have this base level understanding of what to expect in the stock market, so that then you're really not surprised by anything. Because I will tell you, I'm a little bit surprised right now, but not really that surprised, because I truly know from having steeped in this information for long enough that anything can happen in the stock market. And what we're seeing now is definitely wild, but it's not outside of the historical bounds that we've expected. And so let's talk about it. Let's get you some understanding of stock market trends and volatility. And so I do want to say up front, I do not want to be flippant about the fact that volatility is absolutely painful. And I am not saying that it's not. But what I am saying is that if you want to be a good stock market investor, you have to overcome it. It's non-negotiable. If you feel like you cannot get over the pain of temporary losses in your portfolio, then you cannot be a stock market investor, period. And so do know that I 100% know it's painful, but that also believe that a requisite to investing in the stock market is being able to calm yourself down and overcome what are temporary losses of value in the stock market, okay? And so I think it helps to understand why. Why does it have to be this way? It's like, okay, I've been shown this graph 100,000 times in my life, but why is it actually like this? What causes volatility? So let's start there. So what causes volatility? Well, we do. Investors cause volatility. We're the ones that are causing it. Let me explain. So oftentimes when you turn on, let's say, Squawk Box or, Fox Money or whatever minute by minute, kind of bullshit news programming that you're watching would have you believe that it is something like this that has some sort of unilateral or predictable move in the stock market. So for example, you may hear something like this. There's an upcoming election, so stocks are down. Or you may hear oh, consumer spending is up. People are buying, I always forget, is this Burberry or is this Coach? People are buying Burberry scarves and other overpriced wares. And so therefore stocks are up. Or, maybe it's the third Thursday of the month and Saturn is aligned with Venus. And so therefore stocks are down. Or of course the latest, which is the novel coronavirus, is that the novel coronavirus is because of the novel coronavirus, stocks are down, which actually this one is pretty close. But a slightly more accurate way to phrase any of these would be something like this. Because of coronavirus fears, compounded with fears of the upcoming election, compounded with the fact that Dumpster Doggy woke up on the wrong side of the bed today, investors decided that they wanted to sell out of their stocks. This selling caused a drop in demand in stocks and the prices of those stocks, and therefore the stock market moved lower. It doesn't have quite the same ring as just saying the election caused the stock market to move lower, which it's so close, right? And the talking heads do a really good job selling it. But again, there's really only two factors that cause the prices of stocks to move both to the upside and to the downside. And those two factors are supply and demand. Because remember, what we are looking at is just a thing that is for sale out there in an open marketplace, just like anything that is for sale in an open marketplace. It just so happens to be that what is for sale are these tiny little shares of company ownership, right? And so, for example, if there's a stock of a company, let's just say, again, Nike, let's just use Nike as an example. And for whatever reason, I don't know, maybe the CEO puts a puppy through a meat grinder. I don't know why that was my example. I wish I could take it back. I should have thought that one through a little bit better. And investors are oh my God, fuck that guy real hard. I'm going to sell my stock. And that selling is what drops the price of Nike stock lower. And of course, this can happen on a grander scale as well. If everybody's selling their stocks, if everybody's like, ooh, I'm not so sure about owning stocks right now, I'm gonna bail, that's literally what causes the price of stocks to move lower. The same thing happens in reverse. When everybody is buying into the stock market, everybody's like, ooh, yeah, I'm gonna get my stock on. That is what pushes prices higher. So another way to say supply and demand with the market is buying and selling. So this buying and selling, all of these investors disagreeing with one another about what the right price of a stock should be is what causes this short-term volatility. And oftentimes what you get is just like kind of like a ping-ponging back and forth as investors kind of vote on what they think the proper price of a stock should be. But there are times when people act in concert with one another to the upside and to the downside. So right, on the upside, we call it a mania. On the downside, we call it a panic. And so right now what we are seeing is a panic. Investors are all collectively selling out of their stocks. Now, it's a little bit, I wanted to say it's a little bit oversimplified because there is some trading things that are happening behind the scenes. And so it can be exasperated by factors other than just like what you think of as like investors buying in, investors getting out. But in general, what we are seeing is the forces of supply and demand at work. And demand is particularly interesting in this case because basically what we get is this stock market where everybody is voting on what they think the right price of a stock should be. And the reason there's no one consensus agreement is because knowing what the right price of a stock should be would require knowing what's going to happen in the future, which nobody knows. And so you might think Nike stock is overpriced right now. I might think Nike stock is underpriced right now. And really, who the fuck knows if one of us is right? And that's like why I always have to laugh when like the Uber like IPO water cooler bros like, oh, let me tell you about like my hot stock picks. Like this stock is so like undervalued right now. It's such a good buy. It's like, all right, like you don't know what's going to happen in the future, so you really do not know. But like that's cute that you think you do. And so again, how much we as a collective investing unit demand stocks individually, but also stocks in general, is what is causing this thing to grow and shrink in size. It's again, this buying and selling. And it's just such an interesting marketplace and such a unique marketplace because first of all, we're seeing this happen in real time. Like obviously we don't see this with a house. We don't see this with a Tesla, even though those things are also subject to supply and demand, right? And so the interesting thing about the stock market is not only do we see it in real time, but also you get this idea of like future expectation baked into every stock price. What do I mean by that? You would only buy a stock if you thought it was going to make you money in the future. You would only buy into the stock market if you thought it was going to make you money in the future, right? But we all disagree about what's going to happen in the future. And so that's why you get all this jiggering around in the marketplace. And so in the short term, demand and the buying and selling can be pretty wacky and unpredictable because humans are sensitive and wacky and unpredictable. Of course, we're sensitive right now. It's scary out there and we're going to sell our stocks. But at some point, we're also going to get through this thing and investors are going to buy back in. And that's what pushes stock prices higher. So again, how much we as investors or consumers want something quite literally gives it its value. I'm probably like going way over time already. I already know. So sorry, do know again, that this will be emailed out to you if you want to drop off at any point. That's okay, because you will get an email copy if you need to follow up later. I do have one more dating example to illustrate the concept of supply and demand, specifically demand. So I'll go ahead and give it to you because I'm a clown desperate for laughs. I can't hear your laughs, but it's okay. I know they're there. So like think of a person that you had a major crush on in high school, but was totally unattainable. Like maybe she was the captain of the tennis team, or maybe he was the captain of or he was the quarterback, the star quarterback. And so they were in super high demand in high school. So therefore the cost of dating this person was also very high, right? Like you couldn't have acne, you couldn't have frizzy hair, you had to shave your cooter all the time. But 10 years later, they've experienced a career-ending ACL injury. They drink a 12 rack of Miller High Life every night. They are perpetually unemployed and they do not change the toilet paper roll. So nowadays, the demand to date them is low and therefore the cost to date them is low. Anybody could hit that. Like literally anybody could hit that, right? And so how much something is demanded or craved or wanted quite literally gives it its value. And I really drive this point home just because I think it's so helpful in understanding why we see this up and down motion in the market, especially on a short-term basis, which again, in the stock market, a year is a short term. And really it kind of all boils down to this, is that nobody can predict the future. And there's always going to be disagreement about what the correct or the right price of a stock should be because nobody can tell the future. And this buying and selling, this disagreement, we're all essentially voting on what we think the right value of this stock should be. And that disagreement is actually a really good and healthy thing for the market. It's also what causes volatility. But therefore, it would also be wrong to say that any one of those things is what causes all price declines or all price increases, right? Because there are millions of factors every single day that are shaping how much people are globally demanding or wanting stocks. And so think of it as like just investors voting temporarily on what they think the price of a stock should be. In summary, short-term demand is super wacky and unpredictable, but over the long term, something kind of amazing happens. Over the long term, returns end up being a pretty accurate depiction of what happens in the real world. So for example, the investment return, so think of this as like the real growth at the underlying companies, like how much wealth they are actually creating in the world, is this lighter line. The darker line is going to be the stock market's estimation of that value. And what you'll notice is that over a long period, it does a pretty damn good, accurate job of accurately representing the value that is actually being provided, or the wealth, I should say, that is actually being created by the underlying companies. But what you will see is that there are going to be periods where people get way too jazzed and way too sad. Those are manias and panics, right? We will always, like, if there's anything that is 100% certain about human nature and humankind, is that we will continue to see manias and panics. Those are not a thing of the past, right? But in order to be a good stock investor, really you have to believe a couple things are true. You have to, number one, believe that companies overall are going to create additional wealth in the world. So that's number one. And number two, that ultimately with time, the stock market will reflect that, but that it will happen with periods where investors get way too worked up in a frenzy and they also get way too confident about what's going on. That's the natural life cycle of a stock market. But again, over time, if you are willing to give it enough time to work out some of these kinks don't last forever, then I believe that you can be a good stock market investor. There's this really interesting, this is just like kind of like a fun tidbit for you. So like, deep breath. I'll take a glass of water really quick, or drink water. This is a fun tidbit for you. So there's this thing called wisdom of crowds that pertains to the stock market, but it also holds outside of the stock market. And so wisdom of crowds is this idea that when we are all voting on something, we can actually be pretty damn correct as a collective unit. So if you know like the game where you like guess the amount of jelly beans in a jar. I don't know why I chose candy corn. That's way off season. Sorry, I'm sure that's giving some of you a headache. Or guess the amount of candy corns in a jar. If you have critical mass, if you have enough people that are playing this game, and everybody guesses on a piece of paper how many candy corns they think are in this jar, again, if there are enough people, then the average is almost always exactly correct, which is kind of fascinating, right? Like it's like within one or two, it's like it's very teeny margin of error. There's a book called Wisdom of Crowds. It's super interesting. I encourage you to check it out. And so the idea, the reason that I talk about it now is to say that when we're all voting on the right price of what a security or a stock should be, it's probably pretty safe to assume that for the most part, we as a collective unit are pretty right. Yes, we can overreact in both directions, but that overreaction also seems to be a pretty normal and natural part of stock market investing. This is why it makes it so difficult to beat the market, right? If you try to pick individual stocks to do better than the stock market average, which the stock market average is very easy to obtain using an index fund. You just invest in the whole market, get the average, call it a day. But this is why it's so difficult to pick individual stocks, because what you are saying is essentially, I know more than the entire crowd. I know more than the entire investing public, right? I know more than the other person on the other side of this trade. And that's why it's so hard to pick individual stocks. And again, that's not something I'm going to cover in depth. The reason that I bring it up is just to maybe just get comfortable with the idea that there is some wisdom to the stock market. And yes, she seems like she is overreacting right now. She has had better days, but just trust that this is the process that she needs to go through right now. Because there is some wisdom in us all collectively determining what we believe the value of these individual shares to be. All right, so now we're going to actually get into understanding some stock market trends. I will say that history is not necessarily predictive, right? Like we cannot necessarily extrapolate what has happened in the past into the future, but it's also all we've got in understanding what is normal and what is not normal in the stock market. And so first, just think now as like the stock market as a giant mood ring. So basically the stock market, because it's this minute by minute voting mechanism on what the value of companies should be, ends up being like this global, like kind of hippy dippy mood ring. It is a reflection of investors' outlooks on business, the economy, politics, all sorts of things moving forward. The stock market can be thought of as like an anticipation market. The stock market is often anticipating what will happen in the future. Remember, future expectations baked into the stock market. And so therefore, what we typically have tended to see historically, this is your first trend, is the stock market moves out in front of the economy. So the stock market moves first, the economy moves second. And this last couple of weeks is like a pretty good petri dish for which we can observe this exact behavior. 2 weeks ago, we were literally only talking about the stock market crashing, and people were starting to sell out immediately because the novel coronavirus fears started to get more serious, and the stock market reacts first because we can react in the stock market first, right? All of the dominoes that are going to fall in the economy are going to happen much slower, and they're going to happen later, right? And so we often see this. It's not perfect. It doesn't always work like this by any means. But again, stock market and economy are separate. But what we sometimes see is stock market moving out in front of the economy. The reason that I bring this up, especially in this topic under stock market trends, is because I want you to understand that it's also going to happen on the way back up. The stock market is going to start to improve a lot sooner than you feel better about the economy. That's how it happened last time. It's how it's happened every time. Because there gets to a point where things are bad, but they're no longer getting worse, or they're stabilizing. And at that moment, investors will pile back into the market, which will push stocks higher. And that will happen much faster than the much slower rebuild of the economy. And this is why it's just so difficult to try to time the market, because people often go based off of how they feel. But the reality is, if you wait until you feel better to invest in the stock market, you will have missed a whole lot of upside, because the stock market is happening faster than the economy is happening, right? And I'm going to come back to this idea, but again, it's just a very interesting trend to be aware of, that typically the stock market moves fast. Let me give you another quick example of this. In the stock market crash of 2008, it bottomed out in March of 2009, interestingly, March, many, many years ago. And March of 2009, it bounced back up and had an incredible year. 2009, from an economic standpoint, was a fucking disaster, right? We were dealing with the aftermath of 2008 and all that happened in 2008. 2009, we started to see a teeny bit of recovery, but what happened first was investors got right back into the stock market once things had more or less stabilized. And then the stock market went on a precipitous rise from there. And I would argue that people didn't start to feel better until like 2014, 2015. And if you had waited until you had felt better, then you would have missed 6 years of bull market. You would have missed 6 really good years in the market. And so it's just another reason why our sentiment, our feelings about the market are not a good indicator. In fact, sentiment in the world of investing is considered a contrary indicator. So this is getting like a little bit more like investor analyst for you. But in general, sentiment for the investing population is considered a contrarian indicator, meaning that if people feel bad, it's a good time to invest. And if people feel good, it's a bad time to invest. And this is not just true of right now, this is true always. And so it's something to keep in mind. The stock market, another trend. Well, it moves in cycles. And this is another one of those things that you hear people say all the time, but it's easy to be like, okay, like whatever, I get it, it moves in cycles. But it's absolutely true. There are going to be years that are up, and those years are more plentiful. They're also stronger. There are also going to be years that are down. The economy moves in cycles as well. And I mentioned this earlier, but like I feel like we, on some level, we do not welcome an economic downturn, but we understand an economic downturn more than we understand a stock market downturn. But why? Right? They're inextricably linked. And so if you understand that growth does not happen in a linear way, growth does not happen in a straight line up, then you should understand that it doesn't work that way for the stock market, which means it does not work that way for your stock market investments. Because if you are investing in the stock market and you are doing it right, you are along for this ride. You are absolutely along for this ride. Now, here's another one, actually. I often hear like this comparison, like you hear people be like, oh, like the stock market's like a roller coaster, like it's up, it's down, it's crazy. But I do not like this metaphor, because a roller coaster starts back in the same place it started, right? It's like crazy loop-to-loop, make you shit yourself, and right back up where you started. But that is not the case with the stock market. Yes, you go through these more dour periods, these harder periods, but it does move higher over time. In fact, the market has always moved higher, even after some of the worst bear markets in history. So just so you know, so you're familiar, the stock market is up about 2/3 of the time. It's down about 1/3 of the time. We just got really, really lucky with this last bull market. It was exceptionally long. 11 years is a really long bull market. Bull markets tend to last between 5 and 10 years. Of course, they can fall outside of that range. That's just an average. The stock market, or excuse me, bear markets can last between 1 and 2, 3, 4 years. It can also fall outside of that range. But in general, what we see is that the stock market is up more than the stock market is down. Now, it's not super cut and dry, because what you will see during bull markets will absolutely have negative days, months, and even years. So for example, during the last bull market cycle, I believe it was 2013. In 2013, the stock market took a 20% dip, which almost qualified it for a bear market, but it was so quick that people are like, that was just a little blip. But 2013, it was either 2012 or 2013, was absolutely a negative year, tucked right into the middle of a bull market cycle. So again, point is, bull markets are typically longer and stronger. There can be negative days, years, and months throughout. Bear markets can also have positive days and weeks and months. And so do be aware that it's not like super cut and dry. It's like upwards down. It's much more nuanced than that. And it's really only possible to ever understand the magnitude of what we've gone through to the upside or the downside with the benefit of retrospect, with being able to look back at it and be like, oh, okay, that was a good bull market. That was a bad bear market, right? Like we can only look back. We can't know once we're in it because we can't know what's going to happen moving forward. So over the last 100 years, we've had 5, and if we're counting this, 6 really severe, prolonged drops. The Great Depression was the biggest drop we ever had in the US stock market. 2008 was actually the second biggest drop we ever had in the stock market. Just so you are aware, stocks in 2008 in the United States were down negative 55%. We're at about 30 right now. 55%, right? And so another really famous one that you'll often hear talked about is the dot-com bubble. That happened in like 2000, 2001, 2002. And so that was when we had a bubble for internet stocks, a mania for internet stocks that ended up popping, and we had a bear market crash after. The cause of that one was because basically all of these internet companies came out and people were so excited, so stoked about how the internet was going to change the course of everything, which it has. But people just piled into these companies, buying stocks of these companies that had literally never made $1 in their lives. But people were so excited about the potential that they were all piling in. Well, that bubble burst and ended up causing a market crash. And so we've actually seen quite a few market crashes in our lifetime. And so it's probably pretty safe to assume that we will see several more. And so this is very much something that you have to be completely okay with if you're going to be a stock market investor. I'm not saying that it's easy or that it's fun, but it is something that is not just normal and natural with investing in the stock market. I would say that it is a requisite. It is a requirement of the stock market. Because remember, risk and reward, 2 sides of the same coin. You do not get to have one without the other. You do not get to have the bull market without the bear market. That's just not the way that investing works. And so again, if you want the higher chance at return, you have to be willing to put in the work, and that work comes in the form of what's happening right now, dealing with short-term volatility. Stock investing is definitely a no guts, no glory type of game, right? And so do know that this is something that is not only normal and natural, but again, I would argue that it is a requisite to having a higher chance at returns over time. The stock market has never not come back up and moved to higher heights. I'm sorry to use the double negative on you, but it just works best in this situation. The stock market has never not come back up and moved to much higher heights. We have never seen it happen in the history of the market. We do not have a good reason to believe that this time is going to be different. In fact, every single stock market crash, you are going to hear, and I actually heard it, I heard my first one today, actually. You are going to hear forecasters, prognosticators, commentators, your dad, your cab driver, you are going to hear them say these words. You are going to hear them say that this time is different. Coronavirus is different, right? This is the time that stocks go to zero. This is the time the entire system collapses. I just want you to know that those words have been said during every single market crash since the beginning of time. In 2008, do you want to know what every single person was saying? This time is different. This is going to be the collapse of the whole system. This is when stocks go to zero. Guess what happened after a really bad bear market in 2008? We had one of the best bull markets in all of history, because that's what happens. After really, really tough times, after dour times are much more fruitful times, and vice versa. But it does take time. And so time, as you're probably getting right now, another point I would like to hammer home is that stock market investing takes time. You can't make the stock market do something that it won't do. you can really only be along for the ride. And so therefore the best bet that you have is giving it as much time to work as possible. Now, here's another trend that I think is really interesting, because at this point, I get a lot of people asking, like, should I make this move? Should I make that move? Should I make this move? And here's the thing, like, you're asking me about making a move because you want to try to predict what's going to happen in the next year or 2 years, but there's no way to do this. Stock market returns are completely unpredictable. So for example, this is a graph, which if you're looking at this graph and you're like, did you take a picture from a book? Are you a boomer? Like, what's going on here? You're right. I took a picture from my book because I'm under quarantine and I don't have a scanner. And so I had to take a picture from my book. But so yes, this is a really janky picture from my book, but I love the way that this graph illustrates stock returns and the unpredictability of stock returns. So along the x-axis, any of the bars that fall above it, the horizontal x-axis, bars that fall above it are positive years and how positive. And then bars that fall below it are negative years and how negative. And so what you can see, without even worrying too much about like what's going on, what you can do is, like, if you pick one of these bars, it would be very difficult to try and predict in any way what happens next. I guess if you were going to make any prediction, you would predict that it's going to be up, right? Because there's more up than there is down, but it comes in these like completely random fashion, right? We say this about individual stocks, but it can also be said about the stock market, is that stocks are not serially correlated, which essentially means that you cannot tell what a stock will do in the future based on what it has done in the past. If it were so easy, if I could just look at what a stock has done for the last year, or the stock market has done for the last year, then I wouldn't be talking to you buttheads. I would have already bought my own island by now. I would be so rich, right? But that's the thing, is nobody can predict what's going to happen in the future because stock returns are completely unpredictable, right? And so therefore, if we wrap all of this up with a bow, here's what we can summarize. Here's what we can know. First of all, no one knows what's going to happen in the near future. Therefore, no one knows whether on the short-term basis, it's a good or a bad time to invest. Nobody can tell you what's going to happen in the next year. And let me really quickly just say that during these times, during really difficult times, what you tend to see happen with people is people look for gurus and educators and leaders who are extremely confident in their opinion. And your brain is going to want to naturally gravitate to that person. But if somebody is telling you that they can predict what is going to happen in the economy or the stock market or whatever it is, you should actually be very suspicious. Very wise people are the ones that understand the limits of understanding what will unfold in the future, right? So that's just a sidebar. And so to continue on, so we know that we can't know what's going to happen in the near future. All we can know is that the stock market has moved higher over long periods of time. It has never not. So all we can know is that the stock market moves higher over longer periods. Therefore, the longer you hold stocks, the less risky that they become. The longer you hold stocks, the less risky that they become, right? If you only plan on holding stocks for 5 years, you could be sorely disappointed. If you're willing to commit a lot longer than that, you're going to be a lot happier. And so let's wrap this up with just some frequently asked questions that I often get. I'm going to cover all of the questions that you've been sending me real fast using the ideas that we just went over in class. So first of all, I asked this question at the very beginning, and I gave you the part one in the very beginning. Should I be buying into the market right now? Yes, if you feel completely comfortable with your cash situation. If you are completely comfortable with your cash situation and feel stable in your job, and I would also argue don't have any credit card debt, don't have any consumer credit, then yes, get into the market. But don't do it because you're trying to time or like game the market. Don't try to get cute with the market. The market knows more than us. Do it because it's part of your long-term strategy to invest in stocks. Again, timing the market is generally a poor strategy, and study after study after study shows that people fuck it up when they try to do it. Because our sentiment or our feelings about what's going on in the market is generally a very bad indicator. And again, we can't know what's going to happen in the future. But wait a minute, stocks are on sale right now. Shouldn't I take advantage? Yeah, maybe. You've definitely got the right idea, but also be aware that it could get a lot worse before it gets better. And so are you prepared for that? Only you can answer that. If you are completely confident in your ability, I spelled weather wrong, weather this economic storm, and you have nerves of steel, then just keep investing regularly, right? Keep doing whatever it is that you're doing. Keep adding those retirement contributions in that are automatically investing you into the market, right? Keep doing whatever it is that you're doing. Okay, so then I'm ready. What is it that I should buy on sale? Well, I do not make recommendations because I cannot foretell the future. I also cannot make recommendations to your personal financial situation. I don't know you. But I personally prefer a low-cost, diversified approach. I like to buy the entire stock market with a low-cost index fund. That's my preference. And also, I should say, if you want to learn more about the actual investing strategies and the pros and cons of each of the different investing strategies, like should I buy individual stocks? Should I buy mutual funds? Should I buy index funds? Should I use a robo-advisor? Should I do any of the, that's actually covered in my Investing 101 course, and I would love it if you wanted to sign up for that. So next FAQ, if it's going to get worse. So this is like, I get some people that are like, yeah, buy stocks on sale. Okay, and then I have other people that are coming to me and saying, if it's going to get worse, shouldn't I bail out and wait for things to get better? Absolutely not. Again, we don't know what happens next. Maybe stocks do slowly improve from here, and then you just bailed out at the worst time possible. Maybe stocks don't improve from here. Maybe they get worse. But if so, then what is your strategy to get back in? Because again, and this is why I mentioned this earlier about the stock market moving out in front of the economy, the stock market is surely going to improve long before you feel better about things. Right? On March 9th, 2009, which was the low in the stock market, want to know what did not happen? There was no banner in the sky that was like, this is the stock market low, everybody get back in here. There was no such thing. It really took retrospect to understand that that's when things turned around. And this is what happens when people get out of the market and then try to get back in, is they never get back in. And the market bounces back up and then continues on to higher heights. And then they just lost more money than they would have just had if they just had kept with it over time. In general, trying to get cute and outsmart the market does not end well for people. It is a significantly better strategy to just be along for the ride. And if you can, try to train yourself to think about it differently, right? If you remember to the very first slide that I showed you in class, or the second slide that I showed you in class, it was this. The most counterintuitive thing about investing in the stock market is we have the highest potential for returns in the future when we are presently in a bad market. That's now, right? The lowest potential of returns in the market is when we are having a good time, right? And it's counterintuitive because we don't use the words good and bad like that. We're talking about good in terms of what it had just done. It had just come up, so it's good, but it actually may not be a good time to invest. It may be a bad time to invest, right? And so you kind of have to train your brain to think opposite. That said, this is much easier to do in theory than it is to do in practice, because we actually can't time when the worst of the bad market will be in order to get in right at the bottom. And so it makes a lot more sense to just spread it out and keep investing over time methodically, knowing that some of that money is going to get in at points that aren't the lowest, and some are going to get in at the lowest point. And that's really all that you can hope for. at the end of the day, this is something that we always say in investing, and it's a little bit cheesy, but like it's time in the market, not timing the market, right? Trying to get out and get in and work around the bear market crash is so futile. Again, because you will not be able to time the thing, but also because you have to participate in all of the upside in order to return the average, which in my opinion is really the only reasonable goal with stock market investing, is to return the average. And there now have been, and these, in my opinion, these are super interesting. There have been multiple studies that show that if you miss even just a handful of the very best days of investing, and we cannot ever know when those days will be, you absolutely destroy your chance at returning the stock market average. So for example, there was a study by Putnam Investments, and they looked at 15 years of returns in the S&P 500, which is essentially just a measure of the US stock market. If you missed the 10 best days of investing in 15 years, just 10 days of investing, the very best days in 15 years, your annual average return would have dropped from 7.3% to 2.69%. For missing the 10 best days in 15 years. What does this tell us? We have better be there for all of those 10 best days. And we do not know when those are going to come in that 15-year period. And so your best bet is just to be invested throughout. And actually, some of the very best days of investing happen after the very worst days of investing, right? That's the way that it works. When things slam down really hard, they sometimes pop back up. And so if you miss those, like, here's another terminology. So like there's, in investing, there's a thing called a dead cat bounce. And so what that means is essentially that when things are free falling, at some point they may bounce back up. Dead cat bounce essentially means if you throw a dead cat hard enough, even it will bounce back up. And it's a really gross, but the idea is that some of the very best days happen at the bottom when the market is ready to rebound up. And so you cannot risk missing those days. And so you just have to stay invested throughout all stock market periods, knowing that you don't know when those best days are going to come. And really, this is the logical conclusion, is the market is up more than it is down. But since we cannot know when those delicious days and months will be, it's best to simply participate in it as much of it as possible. That's your conclusion from all of this. I could have said that, but I wasted 2 hours of your time explaining why. But that's your logical conclusion. I'm about to show you how cool I was 10 years ago. Here's a quote from one of my favorite Florence and the Machine songs. It's always darkest before the dawn. And you hear this applied to all sorts of things in life, but it's true of the stock market too. It gets really dark before things get a lot better, but it does get better. You just have to give it time for the stock market machine to work. One quick note I want to make about the idea of realized versus unrealized losses. A loss, like a loss in the value of your share of, let's say, Nike stock or your investment in the stock and market in general, is only made real if you sell the investment. Right? For now, what you are seeing on your screen is a loss that is simply reflecting how much you could sell that investment for now, if you wanted to. But that's not the point of investing. You didn't buy a share of Nike to sell it right now, right? You bought this investment in Nike or in the stock market in general to hold on to the thing for decades. And so a loss is only made real when it is realized, and that's selling the investment. We call unrealized losses the losses that you're just seeing on your computer screen, really just this temporary dip in value that is caused by this buying and selling craziness that's happening in the market. And so to summarize, here are your 2 keys of investing success. Number 1, don't sell your stocks right now. This is not the time to sell out of your stocks. It doesn't make sense to, don't sell them at a loss. Don't realize those losses. Imagine an investment that's not a stock. So for example, imagine an investment that is a house. It is a piece of real estate. Let's say you purchased it at point A, and then there was a real estate bubble. And okay, so let's say at point A, you purchased it for $500,000, and then there's a real estate bubble, and then the value of your house declines, and now it's worth $250,000. Would you like panic trying to sell it right now? No, of course you wouldn't. In fact, if you had your wherewithal, you would be like, oh, damn, the houses are on sale right now. Do I have the ability to buy another rental property? Do I have the ability to get into this game more? But it's a lot easier for us and our brains to wrap our heads around when we're talking about a house, because a house provides us with tangible value. Like, you know, it's keeping me warm right now. And so I know it has value, even though you are telling me that the market value is XYZ. But I understand that it has value. In fact, one of my favorite blogs is written by a couple of women. It's called Bitches Get Riches. If you have not read their blog, go read their blog, go listen to their podcast. They are incredible. I think that I got this from one of their their posts, but I think that they said like a stock is so difficult to invest in because it doesn't provide you tangible value. For example, I cannot take a nap in a stock. I cannot take a shit in a bond, right? These things aren't providing me real value, but in reality, they are still an investment. You still own that same percentage of ownership in that company, right? You still own 1% of that company. And what you wouldn't want to do is sell it at point B. What you would want to do is consider buying in at point B if you have the ability. I also think that it's important, once again, to reiterate that the reason that it went from point A to point B is because investors were selling their stocks. The panic that we are seeing out there is causing investors to sell their stocks, which is dropping the value. It's not because you own less of the company, and it's not because that company is necessarily broken. It may have a couple of tough years, but it's not a broken investment. Again, we, the investors, are what is causing the price to temporarily dip in value, right? The call is coming from inside the house, y'all. But again, we have to train ourselves. The old investing adage is be fearful when others are greedy and greedy when others are fearful. But that's a really difficult thing to do. Being greedy when others are fearful, we are in it right now. That's what you're supposed to do. But how hard is that when everybody else around us is saying that everything is about to collapse? It's really fucking hard. But remember, buying in when the market is bad is what gives us a higher potential for returns in the future. It's difficult to do because we were blessed with these like very beautiful brains that were designed to keep us around for many thousands of years in the wild, fighting off mountain lions and whatnot, keeping our young alive. And so we essentially developed what is called a fight or flight mechanism, where we are quite literally hardwired or chemically driven to take action in the face of danger, right? Like if you look at your portfolio and you feel your core temperature rise because you're like, panic, oh my God, what's going on? It actually means that your body's natural response system is working correctly. Like if a bus was about to hit you, you would want that response. You would want to be able to jump out from the bus's path before you even realize that you're doing so. But this natural chemical response that we have that like literally makes you feel like you could like throw a car the length of a football field is very mismatched with this wacky man-made thing we call the stock market, right? And so we kind of have to train ourselves to know that like, hello, I recognize that I am having this response and it is a normal and natural response, but it is also causing me to want to do the wrong thing for the given environment right now. Because again, we kind of have to train our brains to think opposite, right? When things seem really bad is actually a good time to invest. Be fearful when others are greedy, greedy when others are fearful. But this is much easier said than done because again, we have these built-in mechanisms to try to protect ourselves. And so just know that if you feel that way, that it's totally normal and natural. And that's just the reality of the way that it is to be human. Another interesting neuroscience bit for you is that like, we are very much herd creatures. Of course we are. Like, look at all the fashion trends over time that are so incredibly dumb. Like, the only reason that works is because we want to be just like everybody else, right? And that makes sense from a survival standpoint as well. Of course, we had to work as units to be able to survive in the wild. But that also means that when everybody else is in a panic, we are inclined, driven to be in a panic as well. When everybody else is like, I'm making all this money in the stock market, it's so great, you're also going to be inclined to think everything is so great, right? We are very much herd creatures. And so just be aware that a lot of the times good investing means going against whatever is happening out there in the world. Or at the very least, you don't have to like be so contrarian as to like go against the world, just like tune it all out. Really, that's all I'm asking, is tune it all out. And so your second key to investing success is just keep adding money in regularly and for the long haul. Again, be completely unbothered by whatever is happening out there in the stock market. Frankly, we have enough going on. We have enough to focus on. The last thing you need to be worried about is stock prices falling. Because stock prices will come around, the stock market will correct itself with time, but we can't make that process happen any sooner than it's going to happen. Just as a reminder, here's another like little brain bit for you. Like, we are designed to keep ourselves alive for a day. We're like, okay, what do I need today? I need a Snickers bar. I need to rub one out. I need to shake. I got to just like figure out what I got to do today to stay alive. The brain is actually not designed to think long-term about like 40-year-long consequences, right? 10 years in like a normal human lifetime is a really long amount of time. But 10 years in the stock market is a really short amount of time. And so stock market investing certainly requires a stamina that our brains are not used to, and a long-term capacity for thinking about long-term benefit and delayed gratification that our brains just aren't used to. And so now is as good a time as ever to start practicing delayed gratification. And you just got to be really patient as hell, allow this thing to correct itself. And in the meantime, do your best to take care of yourself. That's the significantly more important piece. And just know that this, the stock market is just going to take a while. And so that's it. I know that I went like way over time, so I apologize for that. But I do it because I really want people to understand why they are invested in the stock market, what drives the stock market, and best practices for investing in the stock market. And it's really hard to do that in 30 minutes, if not impossible. And so anyways, thank you all for being here. I'm going to release you. If you want to go, I will stay for Q&A. But before you go, just know that it helps me if you can tell your friends about what I'm doing. I'm just trying to get education out there. I'm just trying to help people make better investing decisions. And I can only really do what I do if I have people that are picking up what I'm putting down. And so follow along, please share with your friends, especially your girlfriends, your sisters, your cousins, your younger coworkers. That helps me live to fight another day. And so anyways, thank you. And now I'm going to take questions. Let me go ahead and really quickly, sorry about this. Okay, great. And then I'm going to pause the recording